Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, October the 5th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we're talking about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on. Not a whole lot of economic data across the pond, but here in the United States, we have a lot going on with the FOMC members speaking. We had Powell speaking this morning and Harker speaking as well. That was earlier on today, and it was right around the time we got some economic data in the form of factory orders. Came in at 1.2%, so that's an increase from last month, which was negative 3.3, and it was expected to be a 1% this month. So much better than last month and better than expected, which is what we would probably likely see with the PMI numbers we saw. Remember on the manufacturing PMI numbers, we saw that they were a lot better than expected at 60. It was at the highest level of reading for the last like 10 plus years. I can't remember exactly what that data point was, but really robust. So factory orders is showing up now. It's more of a lagging indicator. That's why it's important to look at those PMI numbers, because those are forward looking. That's what those purchasing managers are expecting for future orders. So that is more of a leading indicator, but we're seeing that show up in factory orders now because those guys have already seen it, and that's why they're reporting higher numbers on those ISM numbers. That's why that's one of the most important numbers. Then on to natural gas storages, came in at 42 billion cubic feet, expected to be 56 billion cubic feet, so a bit of a pullback there. And then on to the overall markets, we've got crude oil with these economic numbers coming out. I remember I was talking about the drawdown in crude oil. We've got economic numbers picking up. It seems like crude oil was a little off to the downside. Today we're seeing that rebound back into the $50 a barrel area, and it's looking to want to test that Fibonacci level. I think it's going to start to cut through that like butter and start filling in and have a target of 53 in there. So in the near future anyway. So I think that we're going to see it kind of bop around here for a little while. Anytime it's above 50, remember the fracking is going to be able to increase a little bit. We've seen massive amounts of exports in oil, the historical highs on a daily average. So all of those things are good for crude oil, especially with the overall economy if that starts picking up. Gold futures, on the other hand, the economy doing well, should not be pushing much higher. I still think that 1250 target, it's only like 25 ticks away, is definitely in the near future for gold, despite the fact that the gold bugs might try and hold it up. Dollar is gaining strength, and gold should suffer from that. Bonds, you know, the financial sector, and I'll talk about that in a minute, are doing very well. They're like blasting out, and I'm kind of kicking myself for not like jumping on that bandwagon, because when you increase interest rates, the banks do much better. They are allowed to get a little bit more wiggle room on their loaning, because they can scalp the rate in a sense a little bit better when it's at a historical low, or it's in the teen or in the single digits, or below 1%. If it's the higher that percentage point goes on the Fed funds rate, the more the banks can kind of scalp one another on their reserve requirements, and when you go get a loan, that gives them a little bit more basis to play with, so they can increase that basis and gives them a little bit more wiggle room. But when they're at suppressed levels, that just can't happen. So higher interest rates benefit MasterCard, Visa, JP Morgan, and all the banks. All of those, anything that's interest rate sensitive, are going to do very well, and the financials are doing very well right now, and some of them are at historical highs for the in and of themselves. Then we've got the VIX now out on the day. Well, what does that usually correlate to? Higher equities across the board. We've got the Dow Jones yet again creating an all-time historical high, up almost 100 points, and the Nasdaq finally kind of picking up some steam. Remember, I've been talking about the Nasdaq's kind of been a lagger in a sense, where the tech sector was not doing as well as people were putting more money into blue chip stocks. So anytime you get really near these highs, people get a little bit nervous. We were seeing the VIX kind of ratchet up, even though we were at these all-time high, which is a little bit counterintuitive to what one would think. Tech sector was suffering from that. Now we're starting to see some of this good economic data coming out, manufacturing sectors, things of that nature. Nasdaq and some of these more volatile stocks will start benefiting from it. And we have the Nasdaq solidly, or not super solidly, but pretty solidly above the 6,000 mark. It settled above there yesterday finally, and now we are off to the races to the upside in the Nasdaq, finally creating a new all-time high in and of itself, whereas the Dow and the E-mini S&Ps were creating those on somewhat of a daily basis. Today we've got the E-mini S&Ps breaking above the value area high and creating a new value area high in and of itself, but up 11, almost 12 points with the E-mini S&Ps. So all of these things are finally coming into what we would intuitively think the market should be doing with the economic data that we've been getting. So overall market's doing very well and acting accordingly. This is the intraday chart of the E-mini S&Ps. You know, last night after the close, we got a nice spike in there, created a newer high, but you would think sometimes, a lot of times, we see a bit of a pullback on those overnight highs as the longs try to cover before the open of the market. But the economic data we got across the pond and here in the United States, well enough to hold on to that. And then when we got the factory orders numbers and the Fed governor speaking, this market just blasted to the upside and almost unabated. As you can see, there's almost not a red candle in the lot until just recently, when we just created a new all-time high a few minutes ago. Just a bit of a pullback, maybe some profit taking after this nice big rally. You could see that intraday traders would want to take some profits here. Then on to a couple of things. XLF, this is what I was talking about, the financials unabated with this good economic data that we've seen, and then today off to the races, up big again. So XLF is one of those kicking myself for missing out on. Now, earnings, we're getting into that earnings season. I've done webinars on earnings, so check those out because I'm going to be referring back to those a lot in these daily market commentaries. With Costco, has earnings today after the close. I'm going to be probably playing this to the upside, but I'm going to wait, till around probably 3 o'clock Eastern time in order to implement that strategy. So check it out on Pro Trader Strategies, or actually you're going to need to go to my Twitter handle at Wolfman's blog, because that's usually where I'm going to be tweeting those out to let you guys who are following these daily market commentaries know where I'm entering these trades, because I'm not going to be able to do another market commentary and get it out fast enough. So follow me on Twitter there. So I'm going to be playing that to the upside most likely, depending on how that market reacts later on today. But I think Costco is going to do well on their earnings. Then the Deere Caterpillar trade that I put on, this pairs trade, I took it off. It was a little bit better a couple of days ago, but then I talked about this yesterday in the daily market commentary. Once we broke above this resistance level, I decided to pull out on that. My idea was that I was going to see Caterpillar come down and cover this gap while Deere was lagging in a sense behind Caterpillar and had been selling off, that it was going to cover this gap to the upside. Because Caterpillar actually did rather well on their earnings, but the market just didn't like it. And the objective met on the Deere, but not necessarily on the Caterpillar. And once Caterpillar broke above that, I decided to get out. So just as a refresher on Deere, if you guys remember how I set this strategy up, I had on the January, and I was long the 110 calls, and then I was short the 125 calls in there, and I originally paid $12.63 for that. Kind of fudged a little bit on my poor man's covered call with the Deere. It was a little bit rich for the rules that I come up with, but I was pretty sure that deer was going to go, and I always talk about this, do I want the penny or the trade? Well, I wanted the trade more so than the penny on this one. So I played deer to the upside and got out for $15.45. So that one I made about $1.80, let's call it, just for rounding it off in a sense. And then I lost about $1.40 on the Caterpillar trade. And just as a refresher, in Caterpillar, I did the January, bought the 135 puts, and then I sold the 120 puts on that. And I paid $12.02 for that and got out for $9.60. So as you can see there, I lost right around $2.40 on that one, made about $2.80. So all in all, it was a profitable trade. Not quite as profitable as it was the day before, but we never know when we're getting out of those. So how the market was going to react. I thought for sure it was going to break down in Caterpillar and I'd be able to make it on both sides, but it didn't work out that way, but it was still profitable in and of itself. So I'm happy about that one. That's about all I got for today. Haven't added anything because I want to hold off on some margin to create that trade for Costco. That's going to be happening this afternoon, and I'm going to have to hold on to some margin for earnings season. So keep your eyes out for that. Friday's webinar is going to be on the broken wing butterfly. It's a really good one, especially in these markets where we're moving to the upside. We get to all-time highs. Maybe you're thinking something's going to settle down, especially right after earnings or something like that, or something that has high implied volatility. It's going to settle down. We're going to see that volatility come out, but we don't want the risk to the upside. So where do we pick those strike locations? How do we build that strategy in order to increase our probabilities of success? And I'm going to talk about all of those details in tomorrow's webinar. So go to protraderstrategies.com and sign up for that. All right? If you can't take that, take it easy.